Here's something that might surprise you: the device that built Apple into the most valuable company on earth could soon become the very thing that drags its stock price down. Let's unpack that. For years, the iPhone has been Apple's golden goose. Quarter after quarter, it has generated the kind of revenue that makes Wall Street analysts smile and retail investors sleep soundly at night. But a strange and fascinating tension is now building around Apple's flagship product, and it raises serious questions about what comes next for one of the most closely watched stocks in the entire market. Here's the core of the issue. iPhone growth has been slowing. Not collapsing, not crashing, but decelerating in a way that is starting to matter at Apple's scale. When you're a company generating hundreds of billions in annual revenue, even a percentage point or two of slower growth translates into enormous dollar figures. And investors, particularly institutional ones, don't just reward performance, they reward trajectory. The direction of travel matters just as much as where you currently are. The upgrade cycle is a big part of this story. For much of the past decade, Apple benefited from a near-perfect flywheel. New iPhone model releases, longer-term users upgrading, emerging market penetration, and carrier subsidies all combine to push unit sales consistently upward. But that flywheel is spinning more slowly now. Smartphone market saturation in key developed economies like the United States and Western Europe means there are fewer new customers to convert. The people who want an iPhone largely already have one. Then there's China, and this is where things get genuinely complicated. China represents both a massive revenue opportunity and an increasingly serious geopolitical risk for Apple. Huawei's resurgence with advanced domestic chipsets, combined with Chinese government pressure to reduce dependence on foreign technology in state institutions, has created real headwinds for iPhone sales in what has historically been one of Apple's most important markets. Any further deterioration there doesn't just hurt revenue, it sends a psychological signal to investors that Apple's geographic diversification story has a significant vulnerability baked into it. Now here's where the or maybe not part of this story becomes genuinely interesting. Apple is not sitting still. The company's services division, Apple Music, Apple TV+, iCloud, the App Store, Apple Pay, continues to grow at a pace that is frankly remarkable for a business of this size. Services carry dramatically higher margins than hardware, and Wall Street increasingly values Apple not just as a device maker, but as a recurring revenue platform. If services can continue absorbing the growth burden that the iPhone is struggling to carry, the stock narrative changes significantly. There's also the looming question of artificial intelligence. Apple's integration of AI features into iOS, and the broader rollout of Apple Intelligence capabilities, represents what the company is betting will be a new catalyst for upgrade cycles. The theory goes like this: if AI features are compelling enough and hardware dependent enough, millions of users sitting on older iPhone models will have a genuine reason to upgrade. That could reignite precisely the kind of unit growth momentum that has been fading. But that bet isn't proven. The AI upgrade supercycle is a thesis, not a fact. And in the meantime, Apple's stock is trading at a valuation that already prices in a great deal of optimism about the future. When a stock's price reflects perfection, the margin for disappointment becomes razor thin. So here we are, watching the world's most iconic consumer product navigate a crossroads that will define Apple's next chapter in ways that reach far beyond any single earnings report. The real question isn't whether the iPhone is weakening, it's whether Apple has built enough of the future to make that weakness irrelevant. And right now, nobody knows the answer to that yet.